Hey everyone, hope you're having a great day. So today we're going to look at the 111 or the 112 as it's commonly referred to. But let's just call it what it is. It's actually called a bear put ladder. It's a pretty simple trade. Basically what you're doing is you're buying a debit spread and then you're going to sell one or two puts out of the money. This particular trade is just a single put out of the money here. And we can move our strikes around just to kind of see what this looks like. And this trade is actually very deceiving because this is what your profit and loss looks like at expiration. But you're only going to see this at expiration. Before expiration, it's going to look something more like this right here. So as the market drops, you're going to start losing money. And then even worse, if volatility goes up, you're going to lose even more money. This is a pretty nice trade as long as you don't overscale out on it or sell a lot of puts. Naked puts here. A lot of people this week, I think, learned firsthand what Vega is. And hopefully by the end of this video, you'll learn what that is too, because that's what wiped a lot of people out. But I'm going to try and show you maybe a better way to set this up. Okay, so let's think about how we can make this trade a little bit better or easier on us. So first of all, I have just the standard 111 bear put ladder added in here. This is about 120 days to expiration, give or take a few days. And we're long the 50-50, we're short the 5,000, and we're short the 46.50. The 50-50 was around 25 delta. This was 50 points below it. And then this 46.50 was about a 10 delta, somewhere in that range. And we're getting a 34-cent credit, or $34 credit, I'm sorry. And now I'll explain the risk graph here. And we'll take note of a couple of things. First of all, the far right line right here is going to be linked to this top number. And as we move it, we can see how all this stuff changes. The middle line is roughly the price today, and it's in the middle. And then the far left, I've got sitting on roughly 5,100, and we can move that around as well. So this trade is basically, it's short Vega when you enter it, and it's a small positive delta trade. So short Vega means that we want volatility to go down. And long delta means we want the price to go up. And we can see as the market drops down, our short Vega is actually increasing. So this is doing the opposite of what we wanted. And so as the market goes down, instead of losing $288 to every 1% that the volatility goes up, we're losing $411 to every 1% the volatility goes up. And then delta is going from 5 to 9. So instead of losing $5 for every dollar move, we're now losing almost $10. So both of these are hurting us. And one thing that I feel that we can do is to basically set this trade up like a calendar. The problem with going out so far, 120 days to expiration, is this short put here has a lot of Vega exposure. Basically, your longer options, longer dated options have more volatility exposure. The closer you get to expiration, the lower the exposure is. So 21 days in the future here, and that is what this blue line is. Today is roughly 8/11, and 21 days would be 9/1. So if the market drops to roughly 5,100, we're going to be down 1150. And that's no change in volatility. Volatility is going to increase, and so we would probably be down more. But I'm just trying to compare apples to apples here. But anyway, if it drops down to 5,100, we're going to be down roughly about $1,100 on this trade. But if we buy this 50-50 5,000, if we buy just the debit spread, it's going to cost us an $8 debit. And then if we sell something much closer to expiration, say about 28 days, I think this is 28 to 30 days, somewhere in that range. This is actually a September expiration, I believe. So we're selling a put much closer to expiration. And by doing that, at this same 5,100 level, we're actually up about $700. So instead of being down $1,100, we're up $700. And that is because 21 days into the future, most of this put right here has lost all its value to the theta decay. It's only got about 7 to 10 days left on. So that's going to help us a lot more. And what we can do is, every 2 weeks, every month, we can just roll this or sell another one. It's going to be much harder to roll this short put right here that's got 120 days on it. And, once 21 days has passed, we still have 100 days on this put. So I think a way to maybe try to structure this trade is just do it like a calendar and, buy the 50, 50, and the 5,000, buy that out 120 days and just hold that the whole time and sell puts much closer expiration that have a lot higher rate of theta decay. And something else to note is our Vega exposure is actually much less. Even when we drop down here, our Vega exposure is only about 230 now. It was about 410 in the other one. So we have much lower Vega exposure as well. So you'll also notice right here with this trade, we have roughly $110 worth of theta decay if we're trading in this range, and about 57 when we open it. And our original trade actually has a lower amount of theta decay. It's only got about $33 of theta decay when we open it, and about $46 if it gets down here. So we have a higher rate of theta decay as well. And then what you can do is you can just keep opening, more short puts, rolling them as we get closer. So I'm not saying this is going to be the end all be all. I'm not even going to say it's better. I want for, you to decide that. I'm basically just trying to say, you have more than one expiration you can use. You don't have to put, your entire account or your entire trade in one expiration. I think by just stretching it out over expirations, I think it's going to help you out a lot better, in my opinion. But anyway, I just wanted to show that and maybe shed some light that there's just kind of more than one way to try to do this trade. But anyway, thanks for watching. Have a great day. Bye.